Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. A lot to cover today. We're going to update our watch list. We've got a few stocks that we've added as we've spoken to more experts and learnt more about the opportunities out there. We're going to be answering a question on dollar cost averaging, and we're going to be covering the news moving markets, including earnings season.
Yes.
It's in full swing.
News and markets.
Let's get stuck in headlines that we're going to be covering today. The Aussie share market had its worst day since April, a July turnaround for Australian miners, and what we've learnt so far from earnings season. So, Ren, let's start here in Australia with the Aussie share market, which had its worst day since April.
Yeah.
Ouch.
Yeah. I mean, ouch, but also like, I hate this story. I hate the headlines. I hate the way it's reported. News.com.au, ASX falls to its worst day since April. Sydney Morning Herald, banks slump as ASX retreats. It fell 1%.
Yeah.
A 1% fall isn't
deal.
great. It was also a 1% fall mainly driven by the banks when like 10 of the 12 sectors were up.
Yeah.
So like it wasn't that bad a day. It's just that the banks are big in Australia. But just the headlines, the constant headlines and the reaction to like day-to-day news kills me. So let's keep it in perspective. If you saw the headlines, if you were worried, don't be worried. The ASX 200 is up 6% this year. And that's despite a 14% fall between February and April. It recovered that full 14% and then some. The past 5 years, with dividends reinvested, the ASX 200 is up 74%. You've almost doubled your money in 5 years. And that's despite COVID. That's despite the rising interest rates, which saw the market fall off, the unprofitable tech sell-off in the US. That's despite all, the trade war, Liberation Day, everything else. That's despite all of these reasons, you've almost doubled your money in 5 years. So can we just stop it with the day-to-day headlines?
Yeah, honestly, I didn't even see this until we started prepping for this. Didn't notice it in the headlines on some of the papers, which was a good thing.
I guess I'm more sensitive to it because like I'm doing the daily emails, so it's like I'm in it.
News.com, it's classic.
I mean, they're always whenever we want to get on our high horse and have this rant. The first place I'm going to look is news.com.
Keep investing and forget the noise. Really, that's the lesson here.
Yeah, that is the lesson.
Let's keep it here in Australia, where Aussie miners are having a pretty good run at the moment. They've had a soft start to the year. Up to the 1st of July, BHP is down 8%, Rio was down 10%, and Fortescue was down 18%. But Ren, July has been the month of the turnaround story for all of them.
So, the starting point is the iron ore price is up 4%.
Yep.
Getting back close to that $100 a ton mark, a bit below it. But along with the turnaround in the iron ore price, BHP is up 11%, Rio is up 8%, Fortescue is up 12%. So it's been a good July for Australia's major miners. Last Friday, BHP also reported their production, record levels of iron ore production and record levels of copper production. So that's more good news for BHP. And then this week, Australia's iron ore miners got more good news coming out of China. Now, we know that the story with Australia's major miners has been a China story.
Absolutely.
China's demand for iron ore because of their massive building boom. The iron ore gets turned into steel in Chinese steel mills and it goes into Chinese infrastructure. But that's slowed down recently because of the housing slowdown. So Australian investors and mining companies were buoyed by the news that China is building again.
Yes.
The government infrastructure projects they are building the world's largest hydropower dam. And the news this week is that construction has begun. Now, this dam is nuts. It's going to be not as large as the Three Gorges dam, but this will be the largest hydropower dam.
More energy.
But it's like that sort of scale that we're talking about. $257 billion project, and it's going to use a lot of Australian iron ore.
Yeah, that's the link. Obviously, they expect more demand to come.
Yes.
Which is good
Yeah,
news.
yeah,
Good
yeah.
news for the Aussie miners.
It's also a story, another story of China doing making massive investments in
energy.
Renewable energy or zero carbon energy.
Yeah, it's wild. 257 billion. I think I've seen a YouTube doco on the size of this thing, and it's unbelievable.
Yeah, I mean, serious questions from like Pakistan and India about what it's going to mean
Yes.
downstream, but yeah.
Don't think China are worried about that. But
No,
anyway.
no. But look, after a tough 6 months for Aussie miners, it's nice that they're having a good month.
Yeah.
Yeah.
All right. Well, we're going to turn our attention overseas, where earnings season is now well and truly in full swing, and we've got 4 learnings that we've picked out so far. So let's start with the first one, and that is overall companies are beating expectations. Roughly 12% of the S&P 500 companies have reported, with over 82% of those companies beating both earnings and revenue expectations, and that is well above historical averages. So far, only 12%, plenty to go. But if the trend continues, it should be a good one.
Yeah, well, I think so. That's against expectations.
Yeah.
The other way to measure it is just against prior years. So we often talk about year-on-year results for companies, but if we look at it as a cohort, so the 12% of S&P 500 companies that have reported overall as a group, revenue is up 6% year-on-year, but profit is up 9.3% year-on-year.
There you go.
So pretty solid, given all the headwinds that you'd sort of expected to hear about. Things look okay.
Yeah.
And that really leads into our second takeaway, which is that the consumer, the everyday spender, seems to be holding up okay as well.
Yeah, so one of the large, I guess, consumer conglomerates from around the world, 3M, they do workwear, bunch of consumer goods.
Workwear. Do
Yeah,
they? No,
yeah.
they do like Post-it notes and sticky tape.
And yeah, definitely workwear.
Okay.
Yeah, I
Oh,
think
yeah.
they have many verticals.
Yeah,
many
yeah.
consumer
They're
good vertical giant.
Yeah.
That's the other one where I was trying to remember. I'd seen them Post-it notes.
Yeah. Stationary.
Stationary.
Stationary giant.
Yeah.
What
So,
workwear are you thinking?
I'm pretty sure workwear. While you look that up, I'll give it.
Oh, yeah.
Workwear?
Oh,
Bit
yeah.
of workwear?
Yeah, high vis and stuff.
High vis, yeah. The reason I remember that is because they're digging up our footpath out the front of our street at the moment, and
3MR.
the council and all the guys are wearing 3M.
Okay.
Yeah.
There you go. It's like, what's the connection between those two? Post-it notes and high vis workwear. Fluoro yellow.
Yes. Anyway, back to 3M. Finger on the pulse when it comes to the consumer. They've raised profit outlook for 2025, obviously surprising many analysts who expected a more cautious guidance, to your point before, Ren.
Yeah, well, I think you say it's obvious, but it was a surprise.
Yeah.
Like the expectation was a note of caution, and they raised their profit guidance.
Yeah.
So that's big.
And then American Express have come out and reported a resilient consumer as well, and also resilient business spending. So 2 key parts of the market. Overall spend is up 7% across the American Express network, with restaurant spend up 8%.
Yeah.
People loving hitting the restaurants.
And we pulled out that category for a particular reason, because if you think about a consumer that's feeling the crunch, what is the most discretionary spend? What is the thing that you would
Eating
first forego? Yeah, eating out.
Workwear.
Yeah, workwear and eating out
Post-it
too.
notes.
Yeah. So the fact that restaurant spend is up 8%, but restaurant spend is rising faster than overall spend, is a sign that the consumer is going okay. It may also be a sign of food inflation, food price inflation, but I think it's notable.
You also have to think about, this is income inequality, going a little bit on that, but users of American Express.
That is fair. Yeah,
users
yeah.
of American Express versus not.
I mean,
might be in a position to
definitely
spend on restaurants.
I would assume that in Australia, those that use Amex are higher income, but is that the same story in the US?
I'm not sure.
Yeah.
Sure. Definitely here in Australia.
Yeah, definitely. Yeah.
All right. Lesson number 3, or takeaway number 3, is that a reminder that earnings season is an expectations game, and this has shone through via the Netflix earnings report.
Yeah. Netflix crushing it.
Crushing it.
Honestly,
Yeah, I know.
I saw a chart recently that was this is what caused Netflix to fall 70%. And it was their earnings per share. And it's going up and it's going up. And then for one quarter, it was just flat. Share price, that was when it fell, and then it's just kept going up and up since then.
It was that and the loss of
the Russian users.
Russian users.
Yeah. That was all tied in at the same time.
Yeah,
it was such a buying opportunity.
Yeah.
Well, it fell to about 70 billion market cap. Now it's over 500 billion.
Unbelievable.
Yeah. So Netflix had a great quarter. Revenue was up 16% to 11.08 billion. Profit was up 46% to 3.1 billion, and they raised full year revenue guidance. Now, advertising is the new sort of bucket of money that everyone's watching because now they've got this ad-supported tier. They don't split out advertising dollars, but they noted that advertising was on track to approximately double this year. Pretty good.
Pretty good. They'll start telling it when it's a meaningful amount, I feel.
No, they're pulling back on what they're reporting. So they're not reporting user
They've done
numbers.
it for ages, haven't they?
No, I think this is the first year they've stopped reporting user numbers,
Right.
which I think is bull, but anyway.
It's the core of the business.
Yeah. It's because at some point, like,
It's not
the
going to be a
growth
good
rate
story.
can't continue. Yeah. So now they're reporting engagement metrics.
Anyway.
So pretty good numbers.
Yeah.
Profit up 46% year on year. Share price fell 5%.
Unbelievable. So I guess that's saying back to the original lesson here, it's an expectations game. The market were expecting more than that, and it didn't beat. So the stock was punished.
Yeah.
Fundamentally, though, the story's pretty good.
Pretty strong. Yeah. And then the final takeaway, the star of the earnings season so far, Taiwan Semiconductor Manufacturing Company, TSMC. Revenue up 39% year on year, profit up 61% year on year, raised full year sales forecasts. I would say that this is the most important company in the world.
Really?
Yeah.
The most important company.
Because it's like the most important technology in the world, not just for AI, but just generally is semiconductors.
Yeah.
I think that's a fair thing to say at the moment.
Nuclear.
Not.
It's not really a technology, but
some may argue
no
like
energy, no.
Some may argue without oil the world stops,
Yeah.
but we saw what happened when there was a semiconductor shortage in 21 and 22.
Yes.
And then you say, well, doesn't that make Nvidia the most important company? But if you don't have Nvidia, like you have reasonable substitutes. You've got the AMDs and the Broadcoms of the world. Like you could survive. But without TSMC, like you lose that like top best semiconductor makers in the world. Everyone's suddenly lining up.
Samsung have a crack?
Yeah.
They'd love that.
And like this isn't a buy, hold, or sell recommendation because like their importance is sort of priced in a little bit. Like it's not new news to say they're important.
No.
But it's amazing how much they've grown. The stock has kind of been in front of our faces for a while. Like we've
Definitely has been.
Yeah. and actually this is going to be a theme that recurs in this episode because in our watch list segment, I'm going to talk about another stock that's been in front of our faces for a while. But we would have spoken about TSMC, before COVID on the show.
Yeah, that's investing though. Too many opportunities. All
right. Well, as we always like to do, we're going to close out this news section with a what the. And if you want a daily what the, you can get it in our daily news email. Subscribe in the YouTube description or the podcast show notes. But what had us scratching our head today?
Well, it kind of ties into the whole semiconductor space, Ren. China is so desperate to get its hands on some of NVIDIA's most advanced chips that it's started to resort to drug smuggling tactics.
Yes.
Singaporean authorities have recently arrested suspects in an attempt to smuggle chips worth $390 million. How have they done it? Some of the chips have been stashed in crates labeled as tea or toys. I feel like that's not that inventive when some of the cartels are now using submarines and all sorts of bits and pieces. Others were stashed underneath live lobsters to avoid detection.
Well, I think this is the point though. These are just the shipments that have been caught.
Yes. Yeah.
You don't know how they're smuggling them in.
Maybe these are decoy shipments.
Maybe because there was an estimate from a think tank, the Center for New American Security, and they've estimated that between 10,000 and several 100,000 banned NVIDIA chips were smuggled into China in 2024 alone.
Yeah, because $390 million worth of chips in the broad in the big scheme is not actually
not that much. Yeah. And, apparently on like Chinese social media, businessmen are just openly boasting about how they're getting their hands on the NVIDIA chips.
Really?
So, yeah.
Wearing around their neck and like.
So, and NVIDIA deny that there are these diverted shipments that are like, Singapore sales that are then getting pushed into China.
Yeah.
But it seems pretty clear that there are. But I guess that shows us just how in demand these, top tier semiconductors are, reinforcing the importance of both NVIDIA and TSMC.
We love getting questions from you here at Equity Mates. Today's question has come in from Chris via our website.
Hey Alec, hey Bryce. I've been dollar cost averaging into DHHF, and I've recently stumbled across Fidelity's business cycle updates, which seems to suggest that Australia and the US might be in the late stages of the cycle and possibly heading into a recession. So my question is, would it make sense to keep DCAing at my usual rate, or maybe even slow it down for now, but gradually ramp it up? I get it kind of goes against the idea of dollar cost averaging just a little bit, but I was wondering if that was a viable strategy, or should I just stay consistent and stick to the plan?
Love it, Chris. Thank you for the question. Head to equitymates.com/contact to ask your question. We love it if you can leave us a voicemail so we can get your voice onto the show. But Chris, we're going to answer this question in two parts today. The first is going to be around why you can't try and time the market with your DCAs. And second, even if you could time the market, why you don't need to time the market.
Nice. So, to answer your question right at the front, Chris, don't try and vary your DCAs. It does undermine the point.
Yeah.
But let's start with why you can't try and time the market when you're dollar cost averaging. Well, just why you can't try and time the market, full stop. So, no one can accurately predict the market. I think we used this example in a recent episode. Renaissance Technologies, some of the best investors out there, literally CIA code breakers and maths PhDs, they get it right about 51% of the time.
Yeah.
When you're looking at the business cycle, which is what Chris asked in his question, and that's, the business cycle is sort of how the overall economy is going. And remember, the economy and the stock market aren't the same thing, but they are certainly related and they move in a similar direction. But Chris is asking, if the economy is heading into recession, should I hold off? And because thinking that once the economy falls into recession, the stock market will then fall and they'll sort of move in a similar direction.
Yeah.
The starting point here is that sure, they are somewhat correlated, but they don't always move in sync. And importantly, they don't turn at the same time.
No. So going deeper on that, Ren, a key reason that a lot of people struggle to time the market is because we spend so much time analyzing the here and now, trying to think about what is actually going on in the business cycle right now. Whereas the stock market is forward-looking. It's a reflection of where people think we're going, not where we are here and now. And so you'll find recession after recession, time and time again, the stock market turns at the lowest point in the recession, at its deepest, darkest, when sentiment is the worst. That's when it starts to turn.
Yeah, and so if you're trying to time the market, what gets people unstuck is at that point, it's not clear that things are turning. Like it's easy in hindsight, but at the time, you often think things are going to get worse, and there's all of these factors and information and stories coming out that lead you to believe now is not the time to invest, and then you miss the opportunity. And so we did this exercise for our second book, Don't Stress, Just Invest. Side note, winner of the 2024 Best Personal Finance and Investing book. So if you haven't given it a read, maybe go and pick it up. We looked at the last three big recessions, COVID, and then the global financial crisis before that, and then the 2001 dot-com bubble before that. And we said on the perfect time to buy, the day the market turned, what was the information environment at that time? So starting in 2001, the low point actually came in 2002, 9th of October 2002. At that point, the NASDAQ 100, so the tech-heavy index in the US, had dropped 78%. So 3 articles from the Wall Street Journal from that day. Debt woes don't discriminate. Another one, tech stocks close lower and investors seek defensive positions. So again, insinuating that the worst was still to come. From the Wall Street Journal the day before, Wall Street to slash more jobs. And from the New York Post the day after, market could be in for a case of the big blues.
Yes. I mean, you wouldn't know reading those headlines that it was the bottom of the 2001 .com crash.
That everything was getting better from there.
Was better.
Yeah.
Same story plays out with the 2008 global financial crisis, the GFC. So that was 2007 to 2008. The bottom wasn't until the 9th of March 2009 is when the S&P had fallen to its lowest point. That was a 50% fall from its pre-GFC high. If we look at some of the headlines on that day, you have from the Wall Street Journal, the financial storm hits Mexico. So Mexico's in for a ride. Wall Street Journal, China warns of severe fiscal conditions. The Financial Times reporting Obama urged to let banks fail. And then from there on, we had ABC, world at risk of double dip recession. And the Financial Times, the risk of a double dip recession is rising. So you can see there again, like those headlines certainly not making it clear that we were at the bottom.
Yeah, I mean,
some of them very clear. There's worse to come.
Yeah, I mean, it's the contagion is spreading to other countries, Mexico and China, that key industries are failing, and that Obama was urged to not bail the banks out and let them fail, and that the worst economic news was to come with a double dip recession.
Yeah.
So again, it's like this idea that we can accurately distill all the information around us and time the market well, it doesn't really play out. And then really just to labor the point that's probably already been made, let's talk about COVID. So we all sort of remember what happened, but the S&P 500 reached its lowest point on the 20th of March, 2020. At that time, the New York Times was reporting a torrent of job losses threatens to overwhelm the US economy, and a separate article, coronavirus layoff surge overwhelms unemployment officers. Over in the UK, the Financial Times was reporting Sunak primes big rescue plan to help businesses keep paying staff. And it was also reporting US to be swamped by jobless claims. Boeing begs for $60 billion to salvage sector. And the day after that, the FT was reporting pubs, restaurants, and gyms told to close. Businesses were shutting down. They were begging for bailouts, mass unemployment. Businesses were struggling to pay staff. The idea, again, that you could time the market kind of misses the reality of how hard it is.
Yeah.
So I think at this point, it's like, okay, it's really hard to time the market, and that's why we say any attempt to like temper your DCAing or your investment plan based on what you think is going to happen in the market is a fool's errand, but it's a losing game.
Yeah.
Because it's so hard to do.
Yeah.
And there's other research, which I don't think we need to get into, but it's in the book, that talks about if you just miss some of the best days in the market, what that can do to your returns. And the idea is you really want to stay invested. So that's the first part. It's really hard to time the market. But you said there was two parts to this question. The second part was, even if you could time the market, you don't need to.
No, because the power of long-term investing doesn't require market timing. The market average, as we've said 1,000 times on this show, the market average is more than enough. So let's take a look at some numbers. Heading over to the US, if you took a 20-year period from January 2003 to December 2022, and you'd invested $100 a month into the S&P 500 index, you would have invested $24,000 over that period. But as the stock market grows over that period of time, you would have ended up with far more than what you'd invested. By 2022, at the end of the year in December, you would have had $72,822. Now, Ren, if I've got my maths right, you've basically tripled your money in a 20-year period.
And that is despite some tough economic times. That includes the global financial crisis in 2008, the COVID crash in 2020. And if you think about where this question started, the predictions about like where the economy is going and the possibilities of recession, like that 20-year period that you spoke about went through multiple recessions.
Yeah.
And so it's just a reminder that like the market grows in spite of all the reasons to worry and all the things that disrupt it. The market has continued to grow through recessions, good times and bad times. The lesson continues to be the same. Invest early, invest often, just let your money go to work.
Yeah. So Chris, I hope that's answered your question. I think the takeaway here is, as you said in your question, you've been dollar cost averaging for the longest time. I would just keep dollar cost averaging for the longest time. and not worry so much about it. But thank you for your question. As I said, head to equitymates.com/contact if you would like to ask a question yourself. We've got 2 stocks that we have added to our watch list in July. Ren, would you like me to kick off?
I think you would like to kick off.
Yeah, I'm happy to. Yeah, so the stock is Roblox. For those astute listeners, it's a company that I pitched, I think, for stock of the year.
Yeah, it was. Yeah,
was
yeah,
it? Yeah.
It was
Way back, probably during COVID.
It was the year it IPO'd, wasn't it? Because was this the year that
It was the year it IPO'd, I think.
And it hadn't IPO'd at the time you pitched it. Is that right?
No, that was Airbnb. I did that.
Okay, yeah.
No, but,
anyway, it was like 21 or 22. Yeah.
And it did incredibly well, and then it absolutely sunk, and had been sort of swimming around in a pretty flat line for a number of years, and I'd really sort of stopped paying attention to it. But I recently saw it in the TDM Growth Partners monthly email, and it piqued my attention again. So I had a look. And wow, it is back. That is for sure. So firstly, what is Roblox? Launched in 2006. It is an online gaming and creation platform. It allows both developers to develop games, and then obviously users can go on and they play in a user-generated content environment. So it's sort of like a two-sided ecosystem.
It's just the worst way to describe a game.
Well, it's not a game.
I know. It's like a platform.
It's actually
but like kids out there listening would be tearing their hair out at how you've described that.
Well, yeah, fair call. Come at me, kids. Come at me, kids. It's an environment where people make games and play games. That's what it is.
Yeah.
Yeah, and so it has 97.8 million daily active users who log on. That's a 26% increase year on year, and the stock has been performing incredibly well. Year to date, up 111%, and over the past 12 months, up 203%. But that's just off the back of growth. Roughly 5.3 million games exist on the platform, which I was blown away at. Like, that is unbelievable. There's 9.5 million developers developing games on the platform, and you can get paid to develop games. Roblox paid out over $1 billion to developers in 2024. So I jumped on and had a look at what are some of the games that people are playing here. One of their most popular game is one called Adopt Me.
Okay.
It's a social simulation where you build homes and then adopt pets, and you look after the pets in the homes that you build. That's it. There's a game called Tower of Hell, which is that people have designed a simulation for parkour challenges.
Okay.
You know, when you run and jump off walls and stuff.
I think,
and then one of their largest simulation games is called Brookhaven RP. Imagine it like a huge Sims open world town, people just building stuff and engaging with each other.
Yeah.
It's got its own currency, and so people go in and then they buy and trade, and so that's how revenue is generated. But it's just huge. I think when we looked at it years ago, there was an incredibly large amount of young kids playing this game. I don't have the stat in front of me.
It was something like it was 3/4 of 9 to 12-year-olds were playing it.
It was unbelievable.
9 to 12. Yeah.
But the
basically, before you get into the financials, Roblox is like the closest thing we have to the metaverse in 2025.
Yeah. People go in. It's I'm not a gamer. I don't know the term for it, but it's not like role playing. But you're playing live with a bunch of other people who are logging on.
Yeah. Like massive multiplayer online games.
Something like that. Yeah. So in terms of the financials, the revenue story has been pretty phenomenal. So over the past 5 years, revenue's gone from 923 million in 2020 to 3.6 billion in 2024. Revenue growth year on year. So 2020 was 81%, 107%, 16%, 26%, and 28%. So strong revenue growth. It isn't profitable yet, but that is because they are investing pretty heavily into their R&D. R&D spend has gone from 200 million 5 years ago to 1.4 billion.
Yeah, well, I mean, if you just do the maths on what you've told us so far, so $3.6 billion revenue in 2024, 1.4 billion of it going into R&D. Now, obviously, like that doesn't all hit the income statement, but just 1.4 billion to R&D, $1 billion to developers.
Yeah.
From a cash flow point of view, like that's 2/3 of your cash.
Yeah.
2/3 of your revenue. Yeah.
So not profitable yet. I think they lost about 900 million in 2024. They are losing less and less each year, but not profitable. But the story is the growth story and the engagement they have with all these kids.
What's been the inflection point? Like if you look at its chart, it's just absolutely.
It's been pretty flat, and
It
then
was
over
like
the last
it was like
18
April
months,
this year.
Yeah, it's just gone nuts.
No, not 18 months, like 3 months.
For the last 12 months, it's up 200%. To be honest, Ren, I haven't gone that deep. This was just it's on my watch list, so I'll go a bit deeper.
Okay.
Yeah.
Nice one, Roblox.
Roblox, yeah. This came to my attention, as I said, through the TDM email. Signing up to a lot of these fundies is a great way of getting good flow of information. What about you? What's on yours?
So I want to talk about Mercado Libre. Now, for people who are unfamiliar, it's Latin America's largest e-commerce platform. It's got a fintech platform now, operates in 18 countries across Brazil, Argentina, Mexico, Chile. Basically, it's a South American Amazon.
Yeah.
And to just illustrate how much it's basically a South American Amazon, tell me if any of this sounds familiar. Marketplace, an online marketplace connecting buyers and sellers. Mm-hmm. Mercado Pago, fintech payments division used for, for payments in person and online. That's less Amazon.
Yeah.
They don't really have a payments platform per se, or not a big one. But what about this? Mercado Envios, logistics and shipping solutions.
Yeah.
Sounds like Amazon. Mercado Credito provides credit to buyers and sellers, helps facilitate trade. And then Mercado Ads, digital advertising platform, a growing business for Amazon. So the South American Amazon, why is it interesting? Well, it did $21 billion in revenue last year, $21 billion US in revenue last year. But if you look over the last 10 years, the slowest revenue growth rate in any of those years, the annual growth rate in any of those years, 17%. Right. Everything's been above that. But just looking at the last 5 years, revenue growth rate, 73%, 78%, 53%, 40%, 38%.
Seriously solid.
Nuts.
Slowing revenue growth.
Still, 38%.
Can't complain with that, yeah.
Profit, $1.9 billion. Margin is improving though. So the past 4 years, it's gone from a 1% profit margin, 5%, 7%,
that's good
9%.
Yeah.
And that is being reflected in the share price. So in the COVID sell-off of 2022, it fell 65% alongside Roblox, alongside a lot of these like high-flying tech names. But since then, it's ripped almost 250% and it's back past its 2021 highs. This year alone, it's up 35%.
Nice.
So here's why it's on my watch list, and here's why I'm an idiot. And like I'm kind of kicking myself. Because like I have this general thesis around smartphone use and internet penetration.
Yeah.
And so I have this view that in areas where there is less technological adoption, they're kind of skipping it's not my view. It's clearly happening.
Yeah.
They're skipping the desktop stage and going straight to mobile payments, mobile internet, and mobile or like e-commerce, but like through a mobile platform. And there are players that have been early movers and are getting scale and building logistics networks in each of these markets that I think are going to become similar to Amazon. Like it's going to be like a similar winner takes all dynamic, but they're also going to be really well situated to add adjacent services as they sort of get consumers onto their platform.
Yeah.
And I mean, the classic example would be like an Alibaba in China. In India, you've kind of got Flipkart maybe, but you've also got Reliance Jio rolling out the mobile network and cheap phones. But here's why I'm an idiot to get to the point. So in 2022, as a big tech sell-off was happening, I sort of put that thesis into action and bought C Limited, which is the largest e-commerce player in Southeast Asia.
Yeah.
And I also bought Jumia, which is the similar story, but in Africa.
Yeah.
C Limited's up 88% since I bought it, so I'm pretty happy there. Jumia down 36%, probably too early for that thesis to be playing out there. But what I didn't do was buy Mercado Libre, which is exactly the same thesis, just in South America.
Yeah.
It's up 193% since I bought C and Jumia.
Yeah. Not too late.
Well, yeah, so earlier in this episode, I said it's not too late will become a reoccurring theme. And, you know, we saw TSMC for ages and didn't act on it. And so I was thinking, why didn't I act on Mercado? And I think it's because I had this view that it was already too well known.
Yeah.
It's been like a Twitter darling for a long time, and there's been write-ups about it by fundies, and it's just, I kind of had this view that it was known and therefore C and Jumia were better plays because they were less known. But I think an important investing lesson, something that we've learned time and time again, is that a lot of these great companies have a lot further to run than you think. And just because you think something is well known, it's still like not broadly known. Like I would even say today, like Mercado Libre, probably not that well known outside of like meaningful investing circles.
It's not a household name.
Yeah, well, except in South America. But
yeah. Well, I'm just looking at the market share. So like even market share versus Amazon, they're smashing them. Because I was like, I wonder, surely Amazon has a role to play in this. But Amazon only has 5 to 17% in South America, depending on region. Awfully low.
Yeah, Amazon isn't big outside of like Australia, Western Europe, and America. Yeah.
So it's got roughly 30 to 35% across South America. Again, Brazil, Argentina, slightly higher, and whatnot. So even if your story was getting that from 30 to 50%, like there's...
The story is now, if you look at like their revenue chart divided, like you'll see like a bar graph where it's like revenue divided by business unit. The story is like adding business units and adjacent services. Yeah.
Or revenue
because like taking a market share of 35% to 50% isn't just beating a other online retailer. It's like getting people online, building logistics networks.
I think that's what I'm saying. It goes back to the original thesis around as more people in these countries, like
it's
Argentina.
It's a slow burn, but yeah.
But that's what I mean. Again, that's even more of an argument if it's a slow burn.
True, that there's still upside. Yeah. Well, that's why it's on my watch list, because I think there is upside here.
Let alone Chile, Colombia. Plenty of opportunity.
Yeah.
Plenty of opportunity.
It looks like it's expensive at the moment. Trades on about a 60 price to earnings. But, you know, if you could see revenue growth rate and continued margin improvement, you can see that multiple come in pretty quickly.
Love it. Well, those are two stocks on our watch list, Roblox and Mercado Libre. If you have stocks that are on your watch list, we'd love to hear about it. Come and join us in the Facebook discussion group. Hit us up on our Instagram. We love hearing from you, as I said, or equitymates.com/contact, and you can leave us a question, some feedback, whatever it is, send it in. But that does it for today, Ren. We'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.